Most investors make the fatal mistake of assuming that what worked in the past will work again during a recession. They fail to recognize that economies operate in cycles, and each cycle brings a different set of conditions, challenges, and opportunities. The problem isn't that people are unintelligent, it's that they rely on patterns that no longer apply. They look backward for answers when the game has already changed. Every investor, whether they know it or not, is playing within a dynamic system, a system governed by cause and effect. The economy is like a machine made up of millions of transactions, each driven by human behavior, incentives, and psychology. When people earn more, they spend more. When they spend more, businesses grow. When businesses grow, they hire more, and the cycle continues. But when debt levels rise too high, or when optimism turns into euphoria, that same system overheats. It becomes unsustainable, and eventually it needs a correction. That correction is what we call a recession. During these downturns, the rules of the game shift. Assets that looked safe suddenly become risky. Companies that were praised for their growth suddenly face bankruptcy. And the strategies that worked brilliantly in the boom, momentum investing over leverage, blind optimism, become the exact reasons for failure. Most investors fail not because of bad luck, but because they don't recognize that each economic phase requires a different approach. Imagine driving a car and assuming the same speed is safe whether you're on a straight road or a sharp curve. That's exactly how most investors behave. They don't slow down when the conditions change. They don't adjust their strategies. They assume that the trend of yesterday will be the reality of tomorrow. This lack of adaptability is the root of financial pain in recessions. When times are good, confidence rises, risk appetite expands, and markets reward those who take bold bets. Everyone looks like a genius in a bull market. You can buy almost anything, and it seems to go up. But when the cycle turns, that same confidence becomes your downfall. The crowd that once praised buying the dip suddenly scrambles to sell. The media that glorified success stories starts broadcasting panic. Those who built their strategy on the assumption that this time is different find themselves exposed. History is filled with examples of this mistake. Before every major downturn, 1929, 2000, 2008, investors said the same things. The fundamentals are strong. We're in a new era. This market can't crash. But the economy is cyclical because human nature is cyclical. Greed and fear repeat. Debt expands and contracts, euphoria and panic alternate. The faces change, the industries evolve, but the psychology remains constant. If you study these patterns, you start to see that what drives markets isn't just data, it's behavior. People are emotional creatures trying to make rational decisions in an uncertain world. They anchor their beliefs on recent experiences. When markets have gone up for years, they assume they will continue to go up. That's called recency bias. When markets fall, they assume the pain will last forever. That's loss aversion. Both are psychological traps that lead to poor decisions. In a recession, these biases are magnified. Investors who once chased returns now chase safety. They sell quality assets at discounted prices because they can't handle the emotional discomfort of uncertainty. Meanwhile, the few who understand the cycle, those who recognize that fear creates opportunity, are the ones who quietly accumulate value. The difference between them isn't intelligence, it's understanding. Understanding how the system works gives you perspective. It helps you zoom out from the noise. You stop asking, why is this happening to me? And start asking, where are we in the cycle? When you think in cycles, you prepare differently. You don't overextend during the boom. You don't panic during the bust. You recognize that pain and gain are temporary states in a larger rhythm of cause and effect. Let's break this down even further. Every investment you make is a bet on the future. You're not buying what a company is worth today. You're buying what you think it will be worth tomorrow. During expansions, that future looks bright. Everyone agrees, so prices reflect optimism. But during recessions, that future looks uncertain. Fear drives prices down, sometimes far below true value. Most investors don't understand that the greatest returns often come from buying in those moments of uncertainty. They're too focused on the immediate pain to see the long-term opportunity. That's why adaptability is more valuable than prediction. The best investors aren't those who always guess right. They're those who can adjust when they're wrong. They study the system, not the headlines. They ask, what has changed? And how does this new environment alter the rules? The worst mistake is to assume stability in an unstable world. Another layer to this mistake is misunderstanding monetary policy. When a recession hits, central banks respond with tools like lowering interest rates and printing money. This changes the landscape for investors dramatically. Low rates push investors into riskier assets because the returns on cash and bonds shrink. That means the valuations of stocks, real estate, and other assets often rise again, not because their fundamentals improved, but because the cost of money decreased. If you don't understand that mechanism, you'll be lost in the fog of short-term market moves. Most people see the surface, the price chart, the news headline, but not the underlying cause. They react to effects instead of studying causes. That's like trying to predict the weather by staring at a puddle instead of studying the clouds. Real understanding comes from looking deeper, examining debt levels, productivity, spending patterns, and policy shifts. When you connect those dots, you begin to see why the economy behaves the way it does. The reason I emphasize this so much is because I've made these mistakes myself. In my early career, I thought I understood how markets worked, and then I got humbled. I learned that success in investing isn't about being smarter. It's about being more open-minded, more systematic, and more aware of your own blind spots. The market doesn't care about your opinions. It rewards those who align with reality. So when the next recession comes, and it will come, don't ask whether it's fair or unfair. Ask whether you've prepared for the shift. Ask whether your assumptions are still valid. Ask whether the environment you built your strategy in still exists. Because if you're investing based on yesterday's world, you're already behind. The biggest investing mistake in a recession isn't about picking the wrong stock or timing the market poorly. It's about misunderstanding how the economic machine has changed and refusing to adapt. Every investor gets tested during a downturn. Some see it as destruction, others see it as transformation. The choice depends on your ability to think beyond the past and recognize the new game being played. The investors who thrive through recessions are the ones who understand that cycles don't repeat. They evolve. They study history, but they don't live in it. They use the lessons of the past to navigate the future, not to predict it blindly. They know that every recession wipes away complacency and rewards those who remain curious, humble, and analytical. If you want to survive and prosper, don't cling to what worked before. The markets will always change faster than you think. Your greatest advantage is not knowledge, it's adaptability. Because in the end, the economy is a machine. And if you learn how it works, you'll stop fearing its movements and start using them to your advantage. People often say that cash is king, especially when the economy looks uncertain. But the truth is, cash is not always king. It depends entirely on the environment you're in. Sometimes holding cash gives you power and flexibility. Other times, it silently erodes your wealth. Understanding when cash protects you and when it destroys you is one of the most important distinctions an investor can make, especially during a recession. Most people see cash as safety because it doesn't fluctuate in price. You can look at your bank balance, and the number looks the same every day. That feels comfortable. But comfort is not the same as security. What matters is what that cash can buy you. If the value of money is declining faster than the interest you earn on it, you are losing purchasing power quietly and continuously. This is what I call the invisible tax of inflation. It doesn't show up on a statement, but it eats your wealth just the same. Throughout history, governments and central banks have responded to recessions by creating more money. They do this to stimulate spending and to prevent economic collapse. On the surface, it sounds like a good idea. After all, who doesn't want to keep the system running? But the side effect is that the more money you print, the less each unit of that money is worth. You can't create real wealth by creating paper claims to wealth. The real wealth is productivity, the goods, services, and innovations that improve lives. Printing money doesn't create those, it just redistributes value. When there's too much money chasing too few goods, prices rise. That's inflation. It's not a random event. It's the mathematical consequence of monetary expansion. If you're holding large amounts of cash during such periods, your money is effectively melting like ice in the sun. It looks the same in your wallet, but what it buys keeps shrinking. That's why saying cash is king without understanding the economic context can be one of the most dangerous simplifications in investing. During deflationary recessions, however, cash behaves differently. When prices and asset values are falling, cash becomes more valuable in real terms. You can buy more tomorrow with the same amount you hold today. That's why during certain periods, like the Great Depression, people who held cash preserved or even increased their relative wealth. The key is to understand which environment you're in, inflationary or deflationary, and to adjust your strategy accordingly. In today's world, most recessions are met with aggressive monetary easing. Central banks lower interest rates, sometimes to zero or even below, and they inject liquidity into the system. This creates a flood of cheap money that lifts asset prices artificially. It rewards those who own assets and punishes those who hold cash. The saver who keeps money in the bank earns almost nothing, while the investor in real estate, equities, or gold benefits from rising valuations driven by the monetary tide. That's why understanding monetary policy is not optional. It's essential. If you don't know how central banks are managing the supply of money, you're playing the investment game blindfolded. You may think you're being conservative by holding cash, but in an inflationary recovery, that conservatism turns into guaranteed loss. Let's put this in practical terms. Imagine you have a 100,000 sitting in a savings account earning 2% interest. Inflation, however, is running at 6%. That means you're losing 4% of your purchasing power every year. After a decade, your money still looks like 100,000 on paper, but it can only buy what 67,000 could have bought when you started. That's not safety, that's erosion. Now compare that to an investor who uses cash strategically. They might hold cash temporarily when markets are irrationally expensive, waiting for opportunities to emerge. When panic hits and asset prices collapse, they deploy that cash to buy quality investments at discounted prices. In this way, cash becomes a tool, a bridge between cycles, not a permanent home. The difference between losing and winning isn't the amount of cash you hold, it's how and when you use it. Many investors mistake liquidity for security. Liquidity means you can access your money easily. Security means your purchasing power is protected. They're not the same thing. A liquid but depreciating asset is still losing value. That's why understanding real returns, returns adjusted for inflation, is critical. Nominally, you may feel like you're earning something, but in real terms, you could still be going backward. If you study history, you'll see how dangerous blind trust in cash can be. Look at Weimar Germany in the 1920s, or Argentina, or Zimbabwe, or even the United States in the 1970s. In each case, governments increased the money supply to deal with economic problems. At first, it seemed to work, but soon after, prices exploded, currencies lost credibility, and savers were wiped out. The common theme was that people held on to cash because they thought it was safe until they realized it wasn't. Even in milder cases, like the 2008 financial crisis and the COVID-19 pandemic, we saw the same pattern: central banks printing trillions, asset prices inflating, and real yields on cash turning negative. The people who benefited were not those who hoarded money, but those who understood the transfer of value that inflation creates from cash holders to asset owners. This doesn't mean you should eliminate cash entirely. Cash plays a crucial role in flexibility. It gives you optionality. It allows you to act when others can't. The problem arises when people hold cash without strategy, believing it to be a permanent fortress. In reality, cash is more like a temporary shelter. It protects you for a while, but if you stay too long, it starts to collapse around you. The best approach is to think in terms of balance. Hold enough cash to meet your short-term needs, to cover emergencies, and to take advantage of market opportunities. But don't let excess cash sit idle in an inflationary world. Deploy it into assets that preserve or grow purchasing power over time, such as productive businesses, commodities, inflation-protected bonds, or diversified global holdings. Understanding this balance is what separates financial survivors from financial victims during recessions. The victims react emotionally. They see volatility, get scared, sell assets, and sit in cash. The survivors understand that the value of money itself is changing, and they adapt. They think in terms of real value, not just nominal numbers. In essence, cash is not inherently good or bad. It's situational. In a deflationary collapse, it's your lifeline. In an inflationary rebound, it's your silent enemy. The wisdom lies in reading the environment, understanding the central bank's playbook, and positioning accordingly. You don't have to predict the exact timing. You just need to know the direction of forces shaping the economy. The truth is, the idea that cash is king has been one of the most misleading clichés in financial history. Cash has been both a savior and a destroyer depending on the cycle. The key is to see it as a dynamic instrument of strategy, not a static symbol of safety. Real investors don't worship cash, they master it. They know when to hold it and when to trade it for something real. If you want to protect your wealth in the long run, don't measure your success by how much cash you have in the bank. Measure it by how much real purchasing power you've preserved and how much optionality you've kept. Because in a world where central banks can print money at will, the only real kings are those who understand how money truly works. Diversification and balance are not just investment strategies. They are fundamental principles of risk management that protect you from what you cannot predict. The biggest illusion in investing is control, the belief that you can accurately forecast the future. You can't. Nobody can. Not me, not you, not the smartest economists or the most powerful institutions. The economy is too complex, too dynamic, and too interconnected to be perfectly forecasted. The only way to thrive in such a system is to build a portfolio that doesn't depend on being right about any single outcome. That's what diversification does. It acknowledges uncertainty and turns it into strength. Most people misunderstand diversification. They think it means owning many things. But true diversification is not about quantity. It's about correlation. You can own 50 different stocks, but if they all move in the same direction, when a crisis hits, you are not diversified. You are concentrated. Real diversification means holding assets that behave differently under different economic conditions. Some assets do well in growth periods, others in recessions, some in inflationary times, and others in deflationary ones. The goal is to combine them so that when one zigs, the other zags. Think of your portfolio as a system of gears. Each asset is a gear that moves differently depending on the environment. When those gears are properly aligned, the system runs smoothly, even when one gear slips. That's how you build stability. It's not about avoiding loss. It's about avoiding ruin. The people who survive economic downturns are not the ones who never experience losses, but the ones who prevent those losses from destroying them. I've spent decades studying economic cycles, markets, and history. And one thing is clear, the future always surprises us. Every major financial disaster was preceded by people saying, this time is different. In 2008, investors thought the housing market could never collapse because real estate always goes up. In 2000, they believed technology stocks had rewritten the rules of valuation. In every bubble, people find reasons to justify concentration. They convince themselves that risk is gone, when in reality risk is just hidden. Diversification is what protects you from those illusions. The reason it works is mathematical as much as philosophical. When you combine uncorrelated assets, your portfolio's overall volatility declines, while your expected return remains stable or even increases. That's the beauty of the holy grail of investing, as I've called it. If you can find 15 or more good uncorrelated return streams, you can reduce your risk by up to 80% without lowering your expected return. That's not theory. It's been proven over decades of real-world data. Now, balance is what ties this all together. Diversification without balance is like having a team where everyone's playing, but nobody knows their role. Balance means allocating your resources so that no single outcome or asset dominates your future. It's about making sure your portfolio can handle whatever the world throws at it: growth, decline, inflation, deflation, booms, or busts. The challenge, though, is psychological. People don't like balance because balance feels boring. In good times, balance underperforms the hottest trends. When stocks are soaring, the diversified investor looks conservative. When tech stocks triple, the balanced portfolio feels slow. But that's exactly why it works. It saves you from euphoria and despair. It keeps you in the game when others blow up chasing momentum. Most investors are wired for extremes. They want big wins. They chase what's popular. They move with the crowd. But markets are mean, reverting systems. What goes up excessively eventually comes down. What's hated eventually recovers. Balance is the discipline of respecting that truth, even when emotions tempt you to abandon it. It's the art of being humble before the complexity of the world. Let's talk about what real balance looks like. It's not just splitting your money between stocks and bonds. That's the traditional approach, but it doesn't always work, especially when inflation rises and both assets fall together. Real balance means including a range of asset classes: equities, fixed income, commodities, gold, inflation,